rate of return is one benefit. It's important. We got to look at all kinds of other things because you can't spend a rate of return. And that's, you can't, cash flow is not necessarily created based off a rate of return. There's values not just necessarily created. The rate of return is one element that matters, but a lot of times we put it on a pedestal and forget all the other things in our life.
What's going on, everybody? I'm Chris Naugle, and welcome back to the Money School Podcast. This episode might be one of the best you're ever going to hear. And it might be one of the best because we're going to talk about things that you need to pay attention to, things that literally spell disaster or fruitful success for your family's financial future. My guest today is somebody I've known a long time, somebody that's in the exact same space I am. That's right. He's an infinite banking guy, just like us. He has been in the industry for a long time, wrote a book called The And Asset, one you must read. We'll put that in the description, but he thinks exactly the same way all of you do. At least I hope that's the way all of you think. My guest today is Guillams from Better Wealth, and we are going to talk about a lot. But we're going to talk mostly about how you can be your own bank, infinite banking concepts, and what we see coming in the markets. What markets? The stock market. Caleb, welcome to the show.
Dude, you set the bar extremely high. You have some epic guests on, and so I will try to do my best to not have you fall flat on your face with that promise. And dude, it is an honor to be here. And we've had, I think I've been on two. This is the third time, so we're doing something right. If I've been invited back on, and just it's a complete honor, man. I'm excited to get into today.
Before we get into it, like, you may or may not know this movie, but I got to call it out because you said you set the bar high. There was a movie that I think it was in the 2000s about, it was a football movie about a high school football team. There was this coach who called out his lead player, who was this big high school kid, kind of arrogant, thought he was the best player, was the best player. And he had him come out into the field in front of all the other teammates. And he said, I need you to crawl. And when I say crawl, there's a word for it. I don't know what you call it, but without your knees hitting the ground, crawl to the 20-yard mark. Okay. 20-yard line. And the kid was like, I can do that. No problem. But I want you to do it with this guy on your back, which was, at the time they thought he was about 130 pound, one of his other players. So he gets down, but before he gets down and gets ready to do it, he was super arrogant. And everybody's like, this is so easy for him. He blindfolds him. And then the part of the movie goes where this kid is going, he crosses the 20-yard mark and he keeps asking the coach, am I there yet? And the coach is like, almost, you're almost there. Just a little bit further, just a little bit further. And it keeps going like that. And the kid starts, struggling. It's so hard. He's like, it hurts, coach. It's all right. Pain is go. You're almost there. And he just keeps doing it. And then the kid's, really feeling it. You can see he's struggling, but he keeps going the extra, one more. And the coach is pushing him and pushing him and pushing him and pushing him. And then the kid collapses and the other kid gets off his back and he says, he takes the blindfold off and he says, look up. And the kid looks up and he's in the other end of the field. He's in the he made it the entire football field. His teammates can't even believe it. What I'm trying to say is when you set the bar so high that nobody believes it, all you need to do is just blindfold yourself and believe in yourself because there's so much more we can accomplish. One more thing, because this is so important. There was a study done by Harvard with rats. They put a rat in water and they left it there and the rat drowned and they'd revive it. But then they would save the rat and take it out. And it all talks about hope. When the rat thought that there was hope, that rat, I can't remember how much longer, survived like, it was almost unbelievable.
Totally unbelievable. And both the movie and that study are two things that have been very inspiring to me, because if you give someone hope, if you show someone what they're capable of, I'm telling you, it's a game changer. And that's actually transitions quite well into our topic, because at the end of the day, the financial industry, the typical way of helping people with money strips you of hope, control, passion. Like that's one of my biggest problems with if you want to talk about the stock market or whatnot, it's like, what value are you actually creating? Like, how is that making you a better husband, business leader, person? Like it's not, it's literally stripping you of value, putting it into things, investments that we don't understand. And at the end of the day, almost desensitizing us to accomplishing anything. And so like, when you look at the whole system, like no wonder why most people are not like really striving through life. It's because the system is set up to not help you be successful.
100%. And it's always been set up that way. You know, I was an advisor for 16 years. So it was always exactly that way. My job, literally looking back, I wouldn't have said this then, but my job was to get people to think they weren't smart enough to be a good steward of their own money, so that those people gave up control of their money to me, in which I then charged them a fee, a management fee, to manage their assets, of which, to be quite honest, I gave two shits about, excuse my language, but I really didn't care. I cared about the client relationship, but like, whether the money went up, down, sideways, I didn't care as much as the client did. And then in looking back, you know, number one, I feel remorse for the things that I did, but that's just what we were taught to do. So when you look at the entire advisory industry of you know, advisors and just everybody in that world, like, that's what they're trained. And it surprises me that so many people buy into that, just blindly give up control of their money, blindly invest into markets that they have no understanding of. I always say, you know, the 6 laws of wealth, which were derived from the richest man in Babylon, the 7 laws of gold, one of them says it's protect your wealth, only invest in things that you know, like, and understand. Everyone that's watching this right now, please tell me, like, your 401k, your advisory accounts, what you know, like, and understand about the stocks, mutual funds, or ETFs that you're investing in. Do you even know what you're in? The answer almost always is no, I have no idea. I have an advisor that handles that. Do they even know what you're investing in? And do they know, like, and understand? Nope, they don't. What
Nothing else I can say to that. I mean, I think it's a great question for people to just reflect on. And my whole thing is, we talk about the word retirement is just a terrible word. It like almost lulls us to sleep because there's no accountability that's tied to it, retirement. But if we started calling retirement future cash flow planning, like, I'm doing this for future cash flow, you would start seeing things radically different. I don't want to go on a tangent here, but I talked to somebody who was in a very unique financial situation, and I saw that they were putting their money into a 401k. And it's very clear we can't give financial advice, and I'm not investing, like, I'm not giving you investment advice, but I just educated them on like the 4% rule, which is probably should be called the 3% rule. And I just wanted them to know, like, okay, like, I understand that you're getting this match and all this stuff, and we can talk about rates of return all day long, but do you actually understand like the end game plan here? And they didn't. So I just educated them, and I was like, you know, like $1 million, which you're not on the track to get anywhere close to having $1 million, by the way. If you had $1 million in this account, it would produce around 30 to 40,000 in 30 years time period. So it's like 40,000 today is not that much money. 30 years from now. So I just wanted them to start thinking. I'm like, okay, I'm not trying to beat up anything. I want you to understand, like, what is the purpose? What is the result of why we're doing what we're doing? And I find that if we just get people to get really clear and like, this is why I'm doing it because of this, and this is how it's going to work, you're so much farther ahead than just being like, I'm doing this because that's what I've been told to do, and I'm just follow the directions kind of deal. And so I think if we just even change retirement to future cash flow planning, our mindset changes, the accountability changes, because now we can put a metric. We're planning for future cash flow. So we can debate all day long, what's the risk associated with that? What's the future cash flow look like? But retirement has no accountability tied to it because literally people don't even understand it.
Not only that, look at retirement just as a whole. Like, we've literally been told and taught and led to believe that retirement is this magic fictional day where we turn in our papers, we're done, we just ride off into the sunset and all is good. You know what retirement really is for those that just stop working and just go off and do it? Some of the folks I know, they golf for maybe half a year and then they kind of burn out on that. Then they're trying to find their path. And if they don't find their path, they lose the purpose of life. And in the facts, folks, I'm not making this up, are that they die way too soon.
Yeah.
All the time. The thing that we mentioned earlier about hope and about purpose and all that stuff. And I talked about that movie and that study in Harvard because you said, I don't know if I can live up to that. Of course you can. And of course everybody else can, if you believe you can. And, you know, when belief kind of falters, you go to hope. And that is sincerely the most powerful thing on earth. So, but also don't let hope like paint a false picture for your future, because you can't hope your way to wealth. It's a powerful thing. It keeps you going, but you cannot hope yourself to wealth. You can't hope yourself to future income that will be enough to support your family and your future families. Like, listen, like when I talk to people, I don't talk to them about just making enough money for their life. I talk to them about making enough money so that when they're gone, their family, their kids get to live a better life than they did. And then their kids can live a better life, but not just live a better life themselves. I think that's selfish. People ask me all the time, Chris, when's enough enough? Referring to money. And my answer is always the same. There's no amount that's enough. And it's not because I want more or need more. I already don't need more. It's because there's too many other people out there that need help. Too many other animals out there that can't fend for themselves that need help. So when somebody says, when's enough enough? Well, when, child trafficking is done. Okay. When suffering is done, when there's not a single homeless or hungry person on earth, when there's not an animal that is ever threatened, when there's not tigers being killed or elephants, being killed or rhinos having their tusks cut off, when everybody has enough, that's when that's enough. And the answer to that is it will never be enough. So when you take yourself out of the equation of building wealth and you make building wealth about solving somebody else's problem,
that's good.
You will absolutely find that you'll always have more wealth because you changed your focus. It's a universal law. You've changed your focus to giving. Okay. Yep. And when you give or solve somebody else's problem is what I like to call it in business, you then the universe can do nothing other than return back to you. You've heard this all, folks. Like when people make money, they get to a point where they can't stop making money. It's not luck. It's not chance. It's not hope. It's because they understood or tapped into something none of us really fully comprehend, but it is true. It's like gravity, right? If you go to the top of the building, we all know the law of gravity. If you jump off your building, you're going to go splat. There's nothing that's going to change that. Don't try to beat laws. And that is a law of the universe. So when we're talking about money, it's such a simple formula. It really is. You want to become stupid wealthy, folks. And this is what Caleb and I are going to talk to you about. All you need to do is understand the problem that you're solving for somebody else. And when you solve a problem for somebody else, your problem instantly is solved. And, when we talk about the stock market and everything else, like one of the big problems I have taken on, and I know you also have, is, there's so many people being literally right now let off a cliff. I think you and I both are on the same mindset that the markets are certainly done. We are at an all-time high and we can only go down from here. All the signs, all the facts, all the reports show the exact same thing, except for when you watch the news and you listen to Kramer, who says, oh, everything's going to be fine. We're going to soft land. No, we're not. The markets are going to go down. The economy is going to soften and you need to be on the right side of that. So building wealth is really just, or is really right now more of a component of preserving, protecting what you currently have.
Can I play devil's advocate with you?
Please.
So like, even if it wasn't, even if the market was going to go up 12% each and every year, I still wouldn't change my song or dance or what I'm trying to stand for, because it's like, even I'm just playing. I tend to agree with you. You look at the next 30 years, we're not going to we have to understand economics and we have to understand, but like with printing of money, and I do see a world where, the stock market may continue to go up, but like, that doesn't necessarily mean that their theory is right. That's the whole point that I'm trying to make, is like, why do we, I loved what you said about solving someone else's problem. Like that's so key. It's like, if we focus on number one, like how like money, cash flow comes from value. Value comes from serving somebody. That's why I'm a huge fan of capitalism. That's because at the end of the day, when money is flowing, that means there's an exchange where a party is like, yes, I received more value, and that's why I'm giving. That's why it's a deal. If it wasn't a deal, I wouldn't be paying you right now for the exchange. And so I want us to just take that concept and bring it to every part of our life. Because what I find is, in some areas we get it, we make money, but then we turn off our brain into like what we should do with that tool. And so, I agree with you. But even if someone was like, the market's going to average, it's like, okay, what's the point? What value exchange is that happening? Even if the market was continuing to grow, like, why is that? Is that just because of money laundering that the government's doing by printing more money? It's like what? And then on the back end of it, it's like, okay, let's assume that it continues to grow. Like, what's the end result 30 years from now? Are you even happy that you're locking up your money for the next 20, 30 years? Like that, those are the kind of things that I like. I'm like agreeing with you, and I'm even coming in a different direction, because I'm like, even if you were wrong, and even if the market like didn't crash, is it still an area that we want to lock up our money in? That's the question I have. And then it's like, if you understand that the fact that the next 30 years aren't going to look like the last 30 years is a whole nother reason to why you might want to pump the brakes and do something different.
Yeah, I agree. I think, the folks listening to this episode, some people think everything's going to be okay. Some people think, the next Great Depression is going to come. So we got two extremes on both sides.
Yeah.
But what you're saying is it doesn't matter which extreme happens, your tune, your story stays the same. And I love that. So let's dive down that. And really, folks, what we're talking about here is nothing new. This has been around for hundreds of years. I mean, you could trace it back. I did a video talking about the origins of what we're going to talk about. Commonly heard of is privatized banking, back in the day, or the infinite banking concept pioneered by the late R. Nelson Nash, who literally paved the way for everything that both of us do here. But really, it comes down to, let's just assume the markets are going to continue to just go gangbusters because the Fed's going to keep printing trillions of dollars and keep the market artificially inflated. But we won't even go there. Let's just assume the markets are going to go good. A lot of people would say, when they hear, either of us talk, and I love your section in your book about this, people are always like, well, why would I put money into this privatized banking, this specially designed and engineered whole life, when I can put money in the S&P 500 and make 12%? Okay, so that's a relevant question, right? Most of you listening would say, yeah, why would I put money in a specially designed whole life that might pay me between 2 and 5% versus putting money in a S&P 500 ETF that pays me 12%? And just for the record, folks, S&P 500 is not at 12% and doesn't average 12%. We're just hypothetically using a number just so you have a high number to look at, right? So some people would say, yeah, I'd take money from my bank account and I would put money into the S&P 500. That seems like the better choice. If I knew it was going to do 12, that would be the better choice than putting it into the whole life, paying me 2 to 5. Okay. Hold on a second. What if instead of doing the S&P 500, you took the money and you put it into the whole life first? And then once the whole life was funded, you then took money from the whole life and you put it in the S&P 500. Is there anything different? I mean, we'll leave this to the audience. Is there anything different about that? You just changed where the money went first, and then you took the money from the specially designed whole life. We'll just call that your privatized banking system, and then you put the money into the S&P 500. You took a loan from your policy and put it into the S&P 500. Are you indeed still making 12% in the S&P? Yeah, if the S&P made that. And then are you still indeed making the 2 to 5% in the whole life, depending on what year you're in? Yeah, you effectively are. What's the differential in the middle? What the insurance company charges you to borrow your money. So yep. when you pencil it and you run the mathematics, and this is something I've gone deep into, Caleb, I don't know if you've seen it, but I have literally gone to great lengths to mathematically prove all the concepts we talk about day in and day out. Mathematically prove it so that there's no more, well, I don't know if that happens. There's no more, people saying, well, that whole life would never do that. I just mathematically solve for that. But in your book, you said, your book is called The And Asset. You talk about exactly that. This isn't, a this or that asset. This is a this and that. Do you want to elaborate on that?
Yeah. And I actually want to, I will want to talk about something that I think will be a really, really good discussion for us to talk about and maybe even disagree on. And I think there's benefits of saying, hey, we as friends and like people in the space, like we can have conversations that are nuanced. And here's what I'll say is you're 100% right. Anytime someone says I can make a greater rate of return, it's like they're comparing life insurance to an investment, and life insurance is not an investment. So that just tells me like, oh, all they care about is the rate of return. So then we talk about like you could fund a life insurance policy and then take a loan against that life insurance policy, put that money in, and really there's only two big differences to that is the cost that the insurance company is charging you to borrow, and then usually in the first year or two, you don't have all the money that you put in. Correct. Versus like if your money was in a savings account, you would have more quote unquote liquidity. And so then the question goes, this is a common question I'm sure you and I both get, Caleb, if I'm only going to earn, let's say 3, 4, maybe 5% internal rate of return, like actual rate of return in my policy, why would I take a 5, 6% loan somewhere else? So it's, in other words, do we arbitrage using infinite banking? And I actually don't like, if it's just the cash on cash, you don't arbitrage. Let's just hypothetically say you only make 3% in your policy and you're charged 5%. You're not arbitraging. And then people are saying, well, Caleb, why then do you recommend this? You would actually be better mathematically putting your money in a savings account. And this is what it tells me. They have zero value of the benefits that life insurance gives you to your financial life. They don't there's zero value in the death benefit. There's zero value in the chronic benefit riders. There's zero value in the fact that it's when set up and used properly. There's tax benefits that allow our money to grow tax deferred, can be used tax free, gets passed on income tax free. There's zero benefits that come from like, oh, having life insurance in a future portfolio is like bonds on steroids. And there may be benefits that unlock other things. And so what I like to just tell people is if all you care about is arbitrage, infinite banking is probably not like, and this is where we can disagree, but when I look at the math, whole life insurance, which you and I are both a fan of because we're not able to manipulate the numbers like some other insurances out there. It's like, no, you really over the next 30 years may or may not be able to arbitrage. But if all you care is arbitraging your cash, don't do the strategy. But if you understand life insurance as like a actual amazing asset that literally makes 10, 15, 20%, like not 20%, like 20 benefits better. If you understand that, you'd want to put as much money as you possibly could into life insurance and use it as an and, not because of the quote unquote arbitrage, because of all the other benefits. And when you include all the other benefits, it's like crazy arbitrage because you're getting that. So I want you to ask questions. I want us to have a discussion on this because when we talk about arbitrage, like I do believe there's arbitrage. I just believe there's arbitrage when you add in all the other benefits. But if you only care about one number, it's the same people that say life insurance is a bad investment. I'll give it to them. It's like, if all we care about is that, buy term and invest the difference. If that's what you want to do, great. But like, who's going to have a better result over the next 30 years? Me, because I understand that there's more than just rate of return. Rate of return is one benefit. It's important. We got to look at all kinds of other things because you can't spend a rate of return. And that's, you can't, cash flow is not necessarily created based off a rate of return. There's value is not just necessarily created. The rate of return is one element that matters, but a lot of times we put it on a pedestal and forget all the other things in our life. And the last thing I'll say, because you got me on a tangent here, is like a cell phone. This is the example that I use. We all have smartphones. I would bet you majority of people watching this video has a smartphone. Does anyone say to you, oh, well, smartphone's a bad investment because I don't know the rate of return that my smartphone gives me? No, I've never heard that. And yet I will spend, like, I don't care how much money I have to spend per month. Like, the smartphone allows me to do business. It's my alarm clock. It's my white noise machine. It's my maps. It's my timer. I get to call. I get to text. We get to do massive business opportunities on a smartphone. I don't look at it as an investment. I just look at it as an essential thing for my business. That's the kind of how I look at life insurance. I don't look at it as like a invest. I just look at it as an essential part of building my wealth. And it's like, because it's hard to put a value on my smartphone because it does so many things. The same thing, I think of the same thing as life insurance. It's like, don't even try to put it in the same investment category. It does so much. That's why it's a foundational asset for me. And then we could talk about what we should do with it afterwards. So that's kind of my tangent on arbitrage, infinite banking, and all of that. And that's where I'm excited as people get it and mature more, they care less about the illustration and more about the whole concept.
Your real estate business lives and dies by the network and the connections that you make. I mean, after all, your network, well, it's your net worth. That's what you always heard, right? If that's an area where you desire improvement, well, Private Money Club, it's for you. PMC saves you precious time and money by bringing the real estate world, well, right to you, right in the palm of your hand. So get in on the action like so many others have by going to privatemoneyclub.com and sign up.
I agree. And you know, I'm probably one of the ones, and I probably get a lot of haters inside the industry because I do talk a lot about the product and the illustrations, because I know the reason I do is not because that's what I want people to know, but I know that people can't grasp a concept. They need a product, because we have been conditioned and trained and taught to buy products to solve our problems, not learn concepts. So when I first started in this line, all I did is talked about the process, the infinite banking concept, which is the process of taking back the banking functions in your life. We'll cover that in a second. But in doing that, I also realized it's very difficult to take somebody from 0 to 100 talking solely about a concept when all they want to know about is, let me see the illustration, let me see the numbers. So that's why I've spent so much time and energy. And also, just for anybody watching, this is our shop cat. His name is Lazy Cash. He never misses a podcast. But so when we're thinking about that aspect, that's why I've gone that route. But now let's just kind of go into some of the things as to why maybe we differ on some of these different things, which is perfectly fine. I think that's actually the most productive thing that can happen. If we just both agreed on everything, like, listen, we can't learn anything from each other. I always study the wealthy. Okay. What I've done ever since, I got out of the Wall Street world is I've looked at why the wealthy do things differently. And I never believed this as an advisor just because I was pretty much brainwashed. I put the rosy colored glasses on. But when I got out, I started looking at all the wealthiest families. Now, you can start in your own town, or you can then start evolving and start really just looking at the most wealthy families out there, period. The Buffetts, and, you can go back in the families. I'm a nerd about the Rockefellers and the Rothschilds, for good, bad, or indifferent. But I study them, and it cannot be denied the fact that they used whole life insurance for large portions, especially the Rockefellers. They literally created their own family banking system. But when you study that, some people would say, oh, why did they do that? And then we could go down the arbitrage thing. We could go down this, but really comes down to one fundamental principle. They understood that family mattered, and future generations of family matter even more. So in giving that, their money, all of us are going to make money through our lives. We're going to trade hours for dollars. We're going to make money. We're going to sell things. We're going to make more money. And that money all has to go somewhere, right? So where have we been taught to put that money? Let's just keep it simple. Banks. We put money in a bank. But then when you look at what a bank does, a bank takes our money and immediately lends that money back out on houses, cars, remodels, debt consolidation loans, you name it, the bank lends. And on all those loans, they're using our money, they're collateralizing it, and they're making a spread on all that money. So all you need to think about is we're not changing the dynamic of what we do every single day. The infinite banking concept is identical to what you do day in and day out, with one change, and that is where the money goes first. Instead of putting it in their bank where they get to use it, where they get to make money on it, we're putting it in our bank, which is, when I say our bank, it's a specially designed whole life. Why do we use a specially designed whole life? Well, back to the wealthy. Why did the Rockefellers use whole life? Why didn't they use universal life or IULs? Yes, they weren't around then, but they're around today, but they still don't use them. Why do banks, traditional banks, not use IULs? Why do they use only whole life in the terms of BOLI? I don't know. Start asking those questions. You start seeing the path. So money has to go somewhere. By putting it in an insurance company, I can promise you it's safer than being in a bank. Right now, we've lost 5 banks this year, and there are 168 by a study that was just done that are on the verge of collapsing. 168, more than all the banks that collapsed in 2000 or in the Great Recession for the following couple of years. More right now on the verge of collapse. How many mutually owned insurance companies are on the verge of collapsing? 0. Matter of fact, mutually owned insurance companies and whole life products right now, almost all the carriers we work with are raising their dividends. That's weird. Banks are failing and insurance companies are paying more in dividends. That's odd. No, it's not odd at all. You just need to understand why insurance companies do things and why banks do things. They're two different animals. So we got to put our money somewhere. Okay. So I choose and you choose and our clients choose to put their money in a specially designed whole life. Now, is that to make an arbitrage? Maybe for some, maybe not for others, but let's not forget about the way we use money every day. We're always going to need cars. We're probably going to buy houses, or our kids are going to buy houses. We got to fund college for that. We're going to buy things that are going to require money, right? Where's that money going to come from? Your bank account, or you don't have enough in your bank. So you're going to then borrow money from the bank. You gave up control of your money, and then you're going to borrow your money back at a higher rate of return than what you're making. That to me just logically makes no sense. Maybe I'm just too far down the rabbit hole. But over here on the whole life side, I can do the exact same things. I can take money from my specially designed whole life. I take the loan. I buy a car. I just bought a car. Okay. I went to the bank and I asked them what the rate was. 7.8% interest they were going to charge for a used car loan. I can borrow from the insurance company at 5%. So when we talk arbitrage, if the bank's going to charge me 7.8 and my insurance company that my policies are with are going to charge me 5, what's the difference in the middle? Call it an arbitrage, right? I'd prefer to not pay their bank 7.8 and only pay like the insurance company 5. But you see, here's what I do. I don't ignore the fact that the bank was going to charge me 7.8. I would have paid that to Cornerstone Community Federal Credit Union. No ifs, ands, or buts. And most people would. You need a car, you go to the bank, you borrow money, you pay them a monthly payment. So all I did is I ran a calculation for 5 years. What would be my monthly payment for that loan at 7.8%? It was like $1,458. So what I did is I went into my bank and I created a bill pay for $1,478 a month. And when did I end it? 5 years from now. $1,478 comes every single month with a check. I get a bill pay check every month. And guess whose name's on it? Chris Naugle. Why? Why wouldn't it be Cornerstone Federal Credit Union? Because I took back the banking function. You see, I didn't rob myself and pay just 5%, which some could, doesn't matter. I paid 7.8 because I would have given the bank 7.8. And because I know I'm making a spread or an arbitrage in between there. 5 minus 7.8 is what I'm effectively making. It's actually more because I'm paying the loan down, but we won't get into that. And then I put the money back into my policy, which every $1,478 payment I put back into the policy as a loan repayment is $1,478 I have tomorrow. Very different from a bank model too, because if I give Cornerstone $1,478 in a car payment, can I go to Cornerstone and say, hey, I need that $1,478 back next week?
No,
absolutely not. But in my banking system, I certainly can. That money's there and available and can be used anytime I need it for an emergency, for another opportunity, for kiddie food, whatever I need. So for me, those are the simple fundamentals of the money side of it. But let me hit the most important thing. And I alluded to this earlier. Sorry, I'm going off on a tangent, but this is so
no. And
good.
I have a counter for you. So this will be a good conversation, but I want to hear the end. Yeah.
Remember the Rockefellers, in the Rockefeller family bank, one of the most important things about their banking system was not the current generation, it was the future generations. So that means when one of the Rockefellers dies, a death benefit from the policy, their banking system pays back to the trust. And then that funds the future generations so that they can buy more, do more, build more, just create more. Creation is the ultimate. So with me, the one thing I've been doing this well over 20 years now. I have delivered more death benefits than I can count. So we talk about all the fun stuff with cash value, but I'll tell you the number one thing that I understand that is hard for me to articulate. I understand what it's like when one of my clients passes away. And I get a check from the insurance company that I hand deliver or I mail to my client. And then they call me back and they say how that check saved their family, how that check changed their family's life forever. You want to talk about arbitrages and rate of return and cash on cash return. None of that matters. The only thing that matters is when I deliver that check, I see how that family is saved and how that future generation, kids that person that died will never know, how their life will be changed by one thing called a whole life insurance policy. So once you take it to that level, that's why we do what we do. The rest is just fluff. The rest is just like icing on the top or the whipped cream on top or the cherry on top, whatever you want to call it. So over to you.
Yeah. So I love like it's a podcast, but it's just I'm talking, you're talking, we're going on these beautiful rants. I love it, dude. I think we should do like a quarterly session and just record our conversations. The thing I agree with what you're saying. I think the only thing that I just would push back on is I'm not obsessed with the banking function and I'll explain why. I'm more obsessed about efficiency. My definition of efficiency is removing any friction to get to your desired result. So I don't care about, who makes money. Like I just want the most efficient thing for my personal family and our generations. So it's like, if scenario A was the bank made money, but Caleb and his family are better off, versus scenario B, the bank made no money and Caleb and his family were a little less better off, I would choose A. Because I just like at the end of the day, I care about, our family and what's the most efficient for us. So when it comes to like infinite banking, this is where we can have a discussion is in that scenario, I would actually take the bank loan at 7 or 8%. And here's why. I actually will be paying more than I would have been paying myself if I took a policy loan for myself. Like I acknowledge that. Even like I 100% acknowledge that. But I value control and liquidity of my money. And I know that like I have opportunities in business that are far greater than 7, 8%. So I look at anything from debt and opportunities in the same bucket. Because for me, everything comes off of opportunity cost. So an 8% loan is like an 8% investment. And so for me, I don't have unlimited cash. Neither do you, neither does anyone else. So I'm always looking at a couple things. What's going to help me my future cash flow, legacy, net worth, and risk. And for me, I'll work, and I know you will as well, because you have real estate and stuff. I'll work with banks all day long. I just want to make sure that like we are most efficient. And so the thing that I try to get focused on is, what is the goal? What is helping people? If we can save more money into whole life insurance, that's the key. So whether that's you putting money into whole life insurance, buying cars, going on vacations, and then paying your loan back. And that's like your way of saying like, hey, I'm going to save more. And at the end, 20, 30 years from now, I was able to save 25% of my income versus 10%. Great. I'm like, go for it. Versus what if I'm saving 30% over here, and instead of taking money from, against my policy, I'm looking at other opportunities. And so for me, it's like, I think we need to look at how much money we can save long-term for compounding. What is the cash flow that's created, and what's the end legacy? We're both saying the same things. For me, I look at the lens of, I want to be most efficient. I want to factor in risk. I want to factor in those other things. And I care less about the banking function, because I think we're saying the same thing. I just use the word efficiency and you use the word banking function. And I think this is good because in our videos, like, this is good for us to talk about this because, people might get confused, and we're on the same team. Like, we're talking about the same thing. It's just, for me, I'm like, some people in the IBC community, I would love to ask you this. It's like, they're paying off their home early with their policy. I can't even comprehend like what, like I could go as far as to say that could potentially be malpractice if you're like educating people or like encouraging them to pay off a 30-year debt with but again, like, even if mathematically it was possible, it's like, I would rather be sitting on capital that I control versus putting it all into it. So those are the kind of things that we could go all over, and there's different philosophies, but that's kind of where that's when I went down the infinite banking rabbit hole. I got frustrated because I am a math nerd. And I was like, okay, you're saying this, but I want to understand the math. And that's why I appreciate people like you that are like, let's look at the math. And so I'll let you share your thoughts, but like that's the discussion that I probably have the biggest hang up. And don't be confused. Like, we save a ton of money into whole life insurance, and our clients do the same. We just maybe have different language, but I think at the end of the day, we're trying to accomplish the same thing.
Yeah, I agree. And we are saying the exact same thing. So folks, when you're listening to the two of us go back and forth, we're literally saying the same thing. I know you all think like he's got one way and I got another. We're literally doing the exact same things, just in a different way. Now, I'm 46, so I'm a little older. And because I come from Wall Street, I've been around a lot of risk, and I've lost a lot of money because of taking excessive risk. And literally, I call it greed now, and where I'm at now in my life is the path of least risk. Risk mitigation is one of the most high level things.
Simplicity. There's a form of simplicity.
Yes.
Yep.
So when I talk about all the stuff I do with my policies, which is very much different than the way you do it, you're keeping liquidity, and then you're taking opportunities. Now, business opportunities that you control in your own business, let's leave them off the table for now, because there's no one better to invest in than yourself. I think everybody can agree. And if you don't agree with that, folks, you need to really look in the mirror and chant some things to yourself. I am, because you are always your best investment. But let's just say there's other opportunities out there, like you can invest in businesses, you can invest in stocks, you can invest in real estate, all these opportunities which can pay you big returns. For me, at this stage in my life, I have a very light appetite, would be a word, for risk assets. I've sold almost all my real estate. I had 91 units. We flipped 274 houses to date. So I've been in the risk side. I've invested in the riskiest stocks, the riskiest private REITs. And you know what? As a whole, it all worked out. But I didn't like the risk because it keeps you up at night. It makes you wonder whether or not it's all going to be there the next day. And all for what? All for chasing a fictitious return. So now what I do is, now the things that my family enjoys in our lives, like I'm a car guy. I collect Porsches. So I love Porsches. Now you can dislike me or like me for that. It doesn't make a difference. Okay. But what I choose to do is, I know, just like investing in yourself, I know I'm my lowest risk. So if I buy a car, instead of financing it through the bank, I'll finance it through my private banking, and I'll pay myself back. Why? Because there's zero risk there. I'm never not going to pay my loan back to myself. And I do that for a lot of things. Copy machines in the office, the building that we're buying right now. Okay. All these different things, which, yes, I could go get a bank loan for all of them. I'm very bankable, very bankable. Some banks would maybe say no, because banks just don't want to lend right now. But so I'm always going for the least risk in the most simplicity, like you said, which is why I talk so much about cars. And, many years ago, I paid off all my debt. And today still I remain debt free outside of my mortgage, but I am paying my mortgage off. But I love that you mentioned mortgages. This might come as a surprise to a lot of people watching this. I am not paying my mortgage off using my policies. Not one red cent from my policies will ever be used to pay my house off. Not at all. Matter of fact, the money in my policies maybe will be used to add on to my house, but they will never pay my house off. I'll use velocity banking for that, a HELOC and that. I'm not going to get into it, but that's how I'm doing that because of exactly the same reason. Like, I don't want to tie assets up for 30 years or 25 years or however long. I need those assets liquid because you know what? You and I will agree on this. The biggest opportunity of our lives is coming in maybe next year, a year after. And when that opportunity comes, we will need to have liquidity if we're going to seize that opportunity. Otherwise, it'll be just another thing where, I should have, I could have, I would have. So I refuse to tie money up long term.
Majority of people are tied up in 401ks, the market. Like, majority of people aren't even doing anything near what we're doing. They have their money tied up in assets they don't have access to. Then they're forced to take a loan, regardless if they want to or not. And then an opportunity of a lifetime comes. And opportunity of a lifetime literally could be, it doesn't need to be Bitcoin or anything. It could literally just be like an opportunity for you to do something else, invest in yourself. And you're unable to say yes ethically because you don't have control and liquidity and you might have hundreds of thousands of dollars in assets that you can't have access to. And so, I 100%, like, that's how I'm very optimistic in how I view the world. And, for me, I'm just trying to save as much money as possible. And my whole goal is the scenario that allows me to save the most is the route that I'm going to take. And I think, we could talk all day long about techniques, but the reality is majority of people are consumerism are up to their eyeballs, and it's a heart reason of why they're not able to be wealthy. It's not because of whole life or IUL or a Roth IRA. It's literally because you're consuming more than you're creating value. And if there's one thing I love about Jeff Bezos, he's like, create more than you consume. I think if we all just take that advice, create more than you consume, you will be fine. You will be fine if you can just create more in life than you consume. That's a great framework to think about your wealth, is how can I create more in every year with my money and my time than I consume? You'll be in a good place.
I'm going to go two places with this. Earl Nightingale, in his famous The Strangest Secret in the World, talks about the difference between success and failure. Not going to go into the whole story, but the difference between why this study of 125-year-olds and why only 5 of them were successful, 95 were unsuccessful, comes down to what you just said, creation. It is the most powerful thing on earth. Think about it. God created us in his image. God created everything we know. Not getting in, biblical or religious here, but think of it. Creation is the ultimate. What is the reason for failure? Conformity. Conform to somebody's failed ideas. Conform to somebody's failed plan. That's how you fail. Listening to other people who have never done or lived the life you want. That's a pure path to failure. But let me go one step further. Here's something that drives me nuts, and I think we'll agree on this. You see this as much as I do. We talk to thousands of people, and I see this every day. I see people, and the stats don't lie, just crossed $1 trillion in credit card debt. I see people every day in consumerism, racking up credit cards. And then I see those same people putting money into the 401k and risky assets, buying Bitcoin and Ethereum or all those crap coins, or taking, their little money they have outside of all the debt that they've piled up and trying to invest it to try to get ahead. Or betting or gambling or going to the casino and hoping that it's going to hit black instead of red. Whatever way you want. Listen, the fastest way to create wealth is through your own debts and expenses. This is the simplest thing you all should know. Before you ever invest $1, go to the other side of your budget or your balance sheet and look at your liabilities. Credit cards. Most credit cards right now are 20 to 29%. They keep going up. 29%. What would it take, Caleb, to make 29% consistently every single year in your 401k?
Impossible.
It can't happen.
You would be
out
of your mind to plan on that over a long period of time.
It cannot happen.
Even Dave Ramsey will agree with us on that.
Even Dave Ramsey would agree with us on that one. Even Kramer would agree. You can't get 29%. But you know what? Yeah. What if you took the money that you would have given to Kramer or some other guru out there, okay, and you just paid off a credit card? And then you took the exact amount you were paying the credit card and you just put that back in your bank account. What was your return? 20
30%
or 29%. Better than you could ever get in any investment over a long period of time. And you know what? You're going to get that return no matter what, as long as you keep being an honest banker. And notice how I didn't say put it back in your policy. I said a bank account. Take the policy out. It doesn't matter. It's the same freaking thing. So when I see people taking risk and investing money anywhere, oh, I'm putting money in my 401k, I get a match. Who cares? Your match is what? 3%? You're giving away 29 to make 3, and then whatever return you make or lose.
And even the match is a little deceiving because it's like, when does it translate in someday in the future? And it's like, how does that actually going to translate? It's not like people say it's like doubling your money, but it's like, okay, over the next 30 years, what's the actual result of that going to be to your cash flow? Whereas paying off a 30% credit card creates massive cash flow momentum. I actually had a conversation the other day with a friend. They were talking about like, you know how like people who want people that watch this or listen to this, like they want to do the right thing. And they usually are like a little too active. Like they're always looking for opportunities. And I literally looked at this person's financial situation. I'm like, dude, you got $30,000 of credit card debt. You're paying 27% and you just freaking are starting a Roth IRA. Like, are you out of your freaking mind? And like for him, he did not connect it. And this is not a diss to, this is like, there's so many people that can benefit from what I'm about to say right now. It's like, for him, he's like, well, Caleb, like they're two separate things. Like this, I want to invest in my future and all that stuff. I'm like, the best way to invest in your future is to get a guaranteed, yes, I said guaranteed 27% on your money, pay off those credit cards, then take that cash flow. And I said the same exact thing, put it in a freaking savings account. I don't care, right? Like we're not here to talk about life insurance. But it's just like, I love what you said about that. And I 100% agree that there's like, we got to own that. But then at the end of the day, we got to understand the heart of, usually it's not a math problem. It's usually a heart problem of why we're in this situation to begin with. And that's really the conversation. And that's where the becoming your own banker concept is so powerful. And the thinking through the lens of efficiency is so powerful, because to be efficient, you need to know where you want to go, and you need to be self-aware to see any friction to remove that, is to get clear of like what you truly want. And a lot of times we get in this situation because of a lack of clarity and a lack of conviction. And a lot of time, like we're living a world where they're not trying to help us be more clear. We don't have conviction of why we're doing what we're doing. And that's why we're in the financial situations that we're on. If we had a freaking mission, we'd be doing things differently with our money. We would think twice about investing in other people's businesses that go against our values. Like if you are a believer, if you are a Christian, which you and I are, and you're investing in companies that are funding things that go against what we believe, like just think about that for a second. Like you could make the argument that you should just put your money in bonds. I'm not saying that you should do that, but like there's certain things that if we actually dug deep, we would start questioning, not even based on what we're talking about, just like based on like the ethics of what we're doing with our money. And that's where I just believe like the number one investment you can make is in yourself. And there's so many people that are devaluing themselves, and the system is meant to devalue yourself. The system is meant to limit your clarity and conviction that you have in your life. And 100%. That is why we're fired up to get this message out, because in helping clients, we're literally empowering them to say yes to things that not only create more value and that they're passionate about, but literally will allow them to give to more people. And I love your definition of like, start thinking about others and you'll never have enough, because there's always more to serve and give. But if you can think about that framework as it relates to your money, I'm telling you, it's going to be a game changer for your wealth.
There was something strange, and this has happened too many times for me to count. And I want everybody listening to really try to think of a time in your life where this has happened. I was pumping gas in my truck, and a gentleman, I watched him walk across the street, clearly homeless. Okay. Walk across the street, walked right past me, walked over to the garbage can, took the top off and started pulling cans out. I didn't even think. I really didn't. I stopped pumping gas. I walked over to him. I pulled I don't even know how much it was. Pulled all the cash. I don't care. I pulled all the cash out of my pocket and I handed it to him. And I literally just went to turn around. And, and he said, thank you. And I looked back and it almost looked like his eyes were tearing up. Selfless act. Okay. I'm not trying to be the hero. I probably wasn't that much money, probably $50. I never have cash, but I gave it to him, and it didn't take thought. I didn't have to sit at my car and be like, oh, should I? Gosh, I'm going to need this cash. I just did. And you know what happened? and Shauna is my witness to this. I came back to the office. I don't think I even told anybody. And all of a sudden, a check, Shauna gets the mail and she brought me a check. And the check was, I think, $1,000 or $1,500. It was a completely, it wasn't a check you normally get. It wasn't like a rent check. It was like a completely unexpected check out of left field that I had no idea was coming. And then I told Shauna, I said, you know what? I can't help but to think that this check just arrived because I gave. And because the universe recognized that. Now, normally it doesn't happen that quick, but like, I don't care. Have you ever done anything nice for someone? Forget about money. You did something nice. You got somebody to smile. Then all of a sudden you're going out to dinner and all of a sudden a front row parking spot opens up. Did you ever connect the dots? Have you ever just thought about all the things in your life that you've done when you gave and just think about like what happened next? But not only think about what happened, because then you're focused on the get. I want you to also think about how did it make you feel when you did that? Because I know when I gave that man that money, I don't care if he goes and blows it on drugs. It doesn't matter. When I gave him that money, I had such a heightened feeling, I don't know how to describe it, almost a euphoric experience. And I do this every time I give money. I have a euphoric experience of just happiness. It's the only word I can describe it. Love and happiness. Okay. But that same happiness, I can't duplicate when I go buy a new Porsche, when I make a bunch of money on an investment, or I do a loan and I get paid 15%. None of that is even a third of the same happiness I feel when I give. So when you talk about all the things that we can talk about, money, the markets, like infinite banking, these policies and everything else, none of it matters.
Yep.
If you don't understand the sole reason you exist, and that is to solve other people's problems and help other people and give. And if you don't have money to give, make somebody laugh. Give something else in exchange.
Give your time.
Or like, here's the other thing, and you've read about this. Like, let's say you got $10 in your wallet, and literally that's pretty much the last $10 you have. And you were thinking, oh my God, I don't know what to do. Walk around and find somebody that needs that $10 more than you and give it to them and watch what happens.
Yep. Yep. One of my favorite quotes is, the value of your life is always measured by how much of it was given away. So if you look at the people that we still remember to this day, the people that we love the most, it's usually because they gave their time, money, skill set, belief. They gave something to us. And that's the thing that's really going to translate, because we come into this world naked, we're leaving naked, but the impact that we truly have is what we can give now and in the future. And it's not just money, it's the values. It's those of you that have a family, like it's those things that really, the next generation. But I love that this is where this episode went, because I think it's a really, really important conversation, and try to put an ROI on being generous. I can tell you this much: if you're grateful and generous, it's impossible to be anxious and worried. If you come from a generous gratitude place, you can't have gratitude in your life and worry at the same time. So I do think there's without getting too crazy wooey, I believe there's something, because even in the Bible, it literally talks about being generous and being grateful. Like it is impossible as an energy to have both at the same time. And so if we're feeling anxious and whatnot, like just think about all the blessings you have and then give to people that have less than you, and you're actually going to start feeling better. And I'm not a doctor. Don't sue me. But it's just a funny thing will happen. So yeah, man, I love this.
I do too. So, folks, don't make it about money. There's a lot of ways to make a lot of money, and we gave you some great points in this episode, and I hope you take all of them. But just what we just said there is the single most important thing of everything we talked about over the almost hour that we've been going here. So if you just understand that and you just do that, everything's going to be okay. But if you do what I used to do when I was younger and always focus on yourself and your problems and just expect things to be given to you and think everybody should be, jumping, out to help you on everything you do, then your life will continually spiral down and you will live a very miserable life. I know, because I have. Okay. It's kind of like that hair thing. Not only, am I a client, but I'm also, or however he said it, but you get it. That was a bad analogy, but folks, just give.
Yep.
That's what you need to do. Caleb, how can people learn more about you and Better Wealth?
I'm serious about the quarterly conversation that we should have. Like, these are extremely powerful. Maybe we should get some other of our friends on and we should just jam for time. Like, I would love that. We have a YouTube channel. It's Better Wealth on YouTube, and that's pretty much the best place to find us. We're creating content. I'm doing a section called Naked Numbers. You're gonna love this. We're literally stripped down to just your numbers and your situation, and I'm speaking into people's lives for free, because what I found is if we can just have conversations that literally can be talking about you and your goals and what you're up to, and other people can see, there's going to be so much impact. And we've already talked to people, and there's been tears. There's so much more than just the math, and that segment that we're going to be launching in 2024 just proves that like there's more than just math, and it's literally called Naked Numbers for a reason. So follow us on YouTube, and if there's anything that I can do to add value to you and your community, please let me know. I just love what we get to talk about, and the future is very bright, my friend.
I agree. And I will take you up on that quarterly session.
Conversation.
So folks, stay tuned. That's coming. It'll come right to Wealth Webinar, because that's where we're going to do it. And we're just going to have discussions like this. I love the Naked Numbers. That's a freaking genius idea. So folks, in the description, we will put all of Caleb's information. You can check him out on YouTube, on all of his channels, his website. Give him a call, set up a call with his team. I mean, listen, like, this is the stuff you need to learn. With that being said, folks, thank you for joining us for another episode of the Money School podcast, and I can't wait to see you on the next one.